very simply what it should be. So the question was, what about refreshed order books? It says, okay, so if we know where the liquidity is, let's assume that the price candles do the various, this pattern. So let's assume the price opens here, it trades up, and it trades 25, and then it trades back below 25. What happens if you get that? Where do you think the candle's going to refresh the order book? It's going to refresh off the 25s, isn't it? So if I get a trade coming back into this area, I can go short. You agree with that? I can go short because that will have refreshed behind here, almost definitely. So in that sense, I can take a short. Now, what would make that condition stronger? What would make that condition stronger is the fact that there was no buyers at 25 on the way down, right? So if I just continue the trend, what would have made that stronger is the 25 was a failed auction. So on the basis that that is now technically a failed auction when it rejects 25, and you know that 25 liquidity is going to get filled in, 100% you know 25 liquidity is going to get filled in. So you get this impression, you get this idea, okay, well, if I've got a good idea that 25 is going to get filled back in again, then, you know, if I can get a nice easy sell against it, I know where I'm going to. I'm going to be targeting prior swing. You understand that? Did I need depth of market for that? Did I need depth of market for this exercise? Did I need buy-side global? Did I need bookmap? Did I need anything? But is it probably pretty realistic? Is it probably pretty accurate? Probably, right? In most cases, it's probably pretty accurate because as the price moves, and to illustrate the point, I want to show you. To illustrate the point, I want to show you our trades this morning on the Nasdaq. This is, by the way, is the world of a company called 2 Sigma, which we talked about this morning in London. So this is the world of the 2 Sigma trader, and you might wonder why it's called 2 Sigma. Well, there's a very good reason. This between the 1 and the 2 Sigma area is where they're operational. You see that between the 1 and the 2 and the 2 and the 3, with the average middle price for their trading the 2 Sigma. You see that? What? Well, that's it. That's exactly it, right? So they're operational, their average price, guys, is going to be that line there. So that's the 2 Sigma average price point. Interestingly enough, at the 2 Sigma level, you wonder why they came up with the name. Well, so let's think about these for a second. Let's think about this trade. First of all, are we below VWAP? Did we have a failed auction here? Did we then reject 70? Price point of 70. Did we then reject 70, which is going to be a refreshed liquidity level? So if I sold just below that red line and put my stop above the previous pivot, would I make some money? Probably. So when the price then breaks to the downside, it comes up. It's another failed auction against a price of 60. So when the price trades below 60, if I sell below 60 and put my stop above, made some money. The next price that rejects and comes up is 40. If I then sell the 40, if it breaks below 40 and put my stop above, would I make some money? Sure. The next price rejection that does the same is this one here. It keeps going up, and then it rejects 10s. If I sell at 9s, put my stop above, do I make some money? Sure. Next trade that rejects is 23,200. If I sell at 23,199 and put my stops above, do I make any money? Sure. Next price that rejects is 180. If I sell at 23,179 and put my stops above, do I make some money? Sure. Next trade that rejected was the 23,170. If I sell at 23,169 and put my stops above, do I make some money? Sure. Every one of them is a failed auction below VWAP in the 2 sigma area. Every one of them rejects an area and a price that will be refreshed once the sell comes in, giving you more support to the short. We sold it, 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 and we made some monies. And obviously we had an exit price strategy here at 130. You might say, what? An exit strategy at 130? What do you think the exit strategy was, guys, at 130? See if I take this little Fibonacci tool here and I just draw that exit strategy onto my charts there. See it? See where my target price was? It's amazing how counting rabbits can make us a lot of money, right? So you get your rabbit measure, and all of a sudden the price bounces right off your rabbit measure. We start all over again. We get a successful auction, and then we get a failed auction, and then it refreshes off 160. Made some money. We get another failed auction, rejects off 160, makes some money. We get another rejection, rejects off of 100, makes some monies. And at this stage, what's the problem now? It's not the measure. See this number here? That is the one standard deviation from last night, isn't it? It's 251 points. So on the basis that that standard deviation is 251 points to here, I don't want to start selling below that price. Would that make sense? I don't want to start selling below that price. And sure enough, we stop selling below that price. We call it a day on that one. Now, why did I then close off at 23,060? Because that's the end of the delta hedging process from 23,000 from earlier. We talked about it a short while ago, didn't we? We talked about where the delta hedge should come out of this trade, and we had a bit of a conversation about it based on the open interest, didn't we? So there was three reasons, separate reasons why we took trades at this price, why we stopped selling at this price, and why we closed at this price. 3 reasons. And at this point, we then said to everybody in the London session, we had a little classroom on pricing delta. Well, it wasn't really a classroom. It was just a statement. We never did the classroom on it because it does involve some math. But I gave a number to everybody. I says it's 200 points, yes or no? I gave everybody a number that was 200 points. And I also gave everybody a starting point. And what was the starting point, guys? It was 23,350, wasn't it? Sorry, it was 23,250. My mistake. So the starting point was 23,250. That was the starting point. So that meant that our end point was 23,060 towards 50. 23,060 to 23,050. That was our end point. And I said it's unlikely that the market will go below this. And what's happened since then? The market then went bid, and then it went bid. And obviously when the data comes out, it's now jamming around in and around this area. Not very much is happening just now, but obviously the big worry is the 23,000 now. So that trade's finished. I mean, it's gone. It's a brand new trade. It's a brand new sheet of paper. And we're now looking for opportunities to see whether we like this as a buy or a sell. And we are off and running, of course. No trade for me just yet.